Hi, everyone. Welcome to Managerial Accounting and the Cengage textbook of Managerial Accounting with Warren. We're going to start with Chapter 1, and we're going to spend this chapter primarily focusing on these various objectives. How managerial accounting supports the process of management, works with management, and how it's different from financial accounting. Then we'll talk about various types and classifications of costs as it relates to managerial accounting. We'll look at some financial statements in a manufacturing business. And then we'll talk about various utilization rates for service companies. So, for managerial accounting, know that this course primarily creates information and communicates it to inside users of a company. In the financial accounting courses, we primarily deal with information as a whole and in a large picture as it relates for external users, where this information is going to be much more narrowly focused, and it's going to primarily focus the needs of those stakeholders within an organization. So managerial accounting, sometimes called management accounting, sometimes it's called cost accounting, is how we develop information and tools to achieve a company's objectives. These objectives are used for really planning, measurement, evaluation, and control. Now, you see here strategic plannings where the process begins to develop long-term objectives, 5 to 10 years, where operational planning are more short-term objectives. Measurement is where those that are in charge of a certain department or segment develop various guidelines to see how the company's achieving those objectives it's set into place. They evaluate the operations by really looking at monitoring what's happening versus against what they anticipated the results to be. And then control is the steps that management takes to encourage certain behaviors or outcomes within a company. Now, the primary role of managerial accounting is to support the management functions of strategic planning, measurement, evaluation, and control. Managerial accounting does this by developing information and tools for use by the managers for decision making. So here you see the big picture and what we're going to focus on in each of the chapters. Here, there are other management decisions that are aided by managerial accounting that can include activity analysis for use in reducing inefficiencies within the production process, the balanced scorecard for aligning the objectives with performance metrics and then evaluating those performances, and then corporate social responsibility that focuses on objectives such as like reducing the environmental impact of production or providing diversity and inclusion training to all of the various processes. So financial accounting the information in financial accounting gets reported at various intervals throughout the period. It could be monthly, quarterly, or yearly, in what we call general purpose financial statements. So these financial statements, such as the income statement, statement of stockholders' equity, the balance sheet, the statement of cash flows, those are prepared according to what we call our generally accepted accounting principles, or what we call GAAP. These statements are used for external users, those stakeholders outside the company, banks, users to potentially invest in the company. Managerial accounting information is specifically designed to meet the specific needs of a company's management. The information includes historical data, which provide measures of past operations, and estimated data, which provide estimates about future decisions. So here we are going to look at the developing cost information. So in determining how we're going to go about pricing particular services or products, we've got to look at what cost system should we use to record it, and how do we allocate these costs. And there's a lot of overhead costs. So we might have direct costs specifically associated with a product, but then we also have a lot of overhead costs that are linked with many products. And how do we allocate support departments? Janitorial costs, the cafeteria, overall supervisors. And then when we are dealing with joint manufacturing costs, how do we allocate those? Then there may be fixed production costs that we need to look at. And then there are variances. So we might have, we prepare for certain costs, but then the actual costs come in and they're different from what we planned for those costs to be. So many companies are organized by a vertical hierarchy or a horizontal hierarchy. Verticals are referred to as business units because they're structured as separate businesses within a big parent company. And these verticals develop products that are sold specifically to customers, while horizontal units are departments within the company that aren't responsible necessarily for developing products, but their purpose is to provide services to the various other departments. Okay? So, as we look at the various organizations here for McAfee, you see we've got the head executive officers and those individuals that support the CEO. And then you can see the executive vice president along with their supporting staff. So in this scenario, you've got some horizontal support systems and you've got some vertical connects here, as you see on both aspects of this slide. Now, manufacturing operations, we're going to look at guitar making operations of a company called Legend Guitars. Legend guitar making process begins when a customer places an order for a guitar. Once the order gets accepted, the manufacturing process begins when the necessary materials are obtained. An employee then cuts the body and neck of the guitar out of lumber. Once the wood's cut, the body and the neck of the guitar get assembled. When the assembly is complete, the guitar is painted and finished. Now, the direct costs of legend guitars are shown that are specifically related to producing this individual product. The indirect costs can be seen here on the section here of Exhibit 6. A cost objective could be a product, it could be a sales territory, a department, or an activity. Could be research and development. Costs get identified with cost objects, and they're going to either be direct or they're going to be indirect costs. So, depending on the cost object, a cost may be either a direct or an indirect cost. The cost of wood, which would be the materials to create this guitar, are used in manufacturing the guitar, and this is going to be a direct cost of the guitar. Salaries of the production supervisors are considered indirect costs of producing the guitar. The production supervisors do contribute to the production, but their salaries really aren't specifically identified with or traced to any one guitar, which is why they're indirect. The cost of manufacturing products includes the direct materials, those materials that go in specifically to one guitar. The direct labor, those employees are those wages specifically to create that guitar. And this big lump sum that we'll identify and assess a part to called factory overhead. So here, with direct material costs, we start with raw materials. Those raw materials come out of a department, and they ultimately are used to create the finished product. To make a cost a raw material, the cost has to be an integral part of the product that is being finished, and not just that, but a significant portion of the cost of the product. So when we're speaking of guitars, the wood of a guitar is a pretty significant piece of the overall cost of the guitar. Think of the wood in using a guitar, the electronic components if we're talking about a television, silicon wafers if we're talking about computer chips, or if we're thinking of an automobile, the metal specifically for an automobile, the leather specifically for an automobile, and the tires related for that automobile. You can also look at labor. So when you think of labor will be those employees that are there to convert the materials into the finished product. So those wages of employees, when they are significantly being used in order to create the finished product, would be determined and classified as direct labor costs. So direct labor costs need to be an integral part of the finished product and a significant portion of the total cost of the product. So when we're dealing with the guitars, the wages of employees who cut the guitars with the lumber and assemble them, or if we're dealing with automobiles, mechanics that repair automobiles, or if we're dealing with Apple or Dell, those employees that are on the assembly line that help to put together a computer. Costs that are beyond the direct materials cost and direct labor that are still part of the manufacturing process get lumped into this huge broad category called factory overhead. Now, sometimes we call it factory overhead, sometimes we call it manufacturing overhead, but all of this overhead, we call it's indirect to the cost of the product. It's still a component, a big component, but we can't specifically relate it to one specific guitar or one specific automobile. Ideas of this may be in the big factory, the heating, the lighting, the insurance, the supervisors in the factory, repairing specific or generic factory equipment, the property taxes on the building, insurance, and depreciation on the building. Again, all of these costs are necessary in order to produce the specific assets or the specific inventory, I should say, but they're not necessarily pinpointed to just one specific guitar or automobile or snowmobile, whatever you have it. So guys, take a look at this one. For a manufacturer, which of the following would be considered a factory overhead cost? Would you look at it as hourly wages paid to assembly workers? Cost of flour in a cookie factory? Electricity cost in a furniture manufacturing facility? Or hairstylist wages at a mall hair salon? Remember, these are factory overhead. This is not specifically linked to a product. Hourly wages to assembly workers would be direct labor. Cost of flour in a cookie factory, that would be specifically related to the cookies. But what about electricity costs in a furniture manufacturing facility? Wouldn't that be a cost that is real and necessary, but cannot be specifically linked to selling a specific piece of furniture? Okay. Now we've got another way to try to discuss cost. In this course, you're going to see all different ways we break down costs. But in this course, we talk about what we call prime costs and conversion costs. It's really kind of simple, guys. Prime costs are direct materials and direct labor costs. Period. That's it. Prime costs, direct materials, direct labor. Conversion costs consist of the direct labor and the factory overhead costs. So these conversion costs are the cost of converting the materials into a finished product. The direct labor is both a prime cost and it also falls in the conversion cost category. Product costs is a manufacturing company that's in a manufacturing company are recorded and get reported on the balance sheet as inventory. No, product costs are inventory until they're sold. The cost of the manufactured product sold is reported in the income statement as cost of goods sold. So when we're dealing with a service company, the product costs aren't reported as inventory because the cost of a service usually is going to happen in the same period that the service is sold. When we're dealing with a manufacturing company, usually those costs of a product can be sold in the same period, but depending on what type of company it is, let's think of a house. Those product costs will stay in the balance sheet as an asset in the current assets section of inventory until that actual home gets sold. Okay? So let's look at this next question. How are manufacturing companies and service companies alike? Is it A, they both produce products? Or B, they both have product/production cost? C, they both have labor, materials, and overhead cost? Or D, they both have manufacturing costs? What do you think there? So a manufacturing company creates the product. A service company doesn't necessarily have a product they're creating, but they have a service that they are creating. Okay? So the similarity with both manufacturing and service is that they both have labor, materials, and overhead costs. Okay, here's another one. Cost associated with hospital caregivers providing care is similar to, would that be direct labor costs, direct material costs? Would it be factory overhead costs? Or would it be manufacturing costs? This is the specific cost with the caregivers. Wouldn't that be direct labor costs? Those are labor costs when we're dealing with employees. And which of these is not a factory overhead cost? Would it be the cost of heating and lighting the factory? Now we know that's an overhead cost because we can't really specifically associate the lighting of the factory and heating of the factory with a product, and same with property taxes, and same with insurance on the factory. But what about the material costs for the finished product? Wouldn't that be direct materials cost? Remember, the factory overhead costs are those that are needed and necessary, but aren't specifically linked or tied to a specific product. So guys, how about this one? Which of the following are ways in which managerial accounting provides information and reports for managers to use in operating the business? Would it be that managerial accounting provides the cost of manufacturing a product, which can be used to determine its selling price? Or managerial accounting allows for comparing the cost of manufacturing products over time and can be used to monitor and control the cost of direct materials and direct labor and factory overhead? Or that performance reports allow management to identify any large amounts of scrap materials or employee downtime? Or is it all the above? What do you think? Well, if you said all the above, you are right on. In this scenario, managerial accounting provides information in so many facets that managers can use to help better themselves in operating a business. What about this one? What cannot be identified with or traced specifically to a cost object? Wouldn't it be indirect costs? That's why they're indirect costs, because they cannot be specifically traced. And then how about this one? What consists of selling and administrative costs? You're going to see this soon. I don't think we've talked about this yet, but know that period costs aren't specifically related to selling a product. They fall in the income statement in the period in which those costs get incurred. Now, inventory that consists of the direct and indirect materials that have not yet entered the manufacturing process. What's that known as? Just so you know, this is going to be materials inventory. We're going to talk about this. These are materials that are sitting in an inventory account called materials that have not been requisitioned yet in order to start producing a product. And then we have inventory that can consist of direct materials, direct labor, and factory overhead for products that have entered into the manufacturing process but have not yet been completed. That's going to be work in process inventory. So in a manufacturing company's financial statements, the asset section of the balance sheet is going to be much broader, much more detailed than that of another type of company. In the inventory, those items that are in process that have not yet been sold will show in the inventory section of an income statement. Now, they could be shown as raw materials. They could be shown as work in process. They're still working on the inventory and on the products prior to completing them. Or if they have completed them, but they've not yet been sold, they would still be sitting in inventory as finished goods. The total cost of making products that are available for sale during the period is called cost of goods manufactured. That's what's been manufactured during the period. So here, this exercise is going to be kind of interesting. So what we're going to do here, we're looking at various costs. Indicate whether each of the following costs of a motorcycle manufacturer would be classified as direct materials, direct labor, or factory overhead. And think about it. It would be direct material or direct labor if this cost is specifically associated with what we are producing, that specific item we're producing. So a motorcycle engine would be a direct material cost because you need one engine to go into one motorcycle, and it is clearly definable. But what about the depreciation on robotic assembly line equipment? That equipment is used to assist and to guide the work of completing all of these motorcycles, not specifically one in particular. So that would be a factory overhead cost. It's still an important cost, but it's not tied to one product. Brake pads, direct material. Same with glass for the windshield. Tires would also be direct material costs. You know, you need 2 tires for a normal motorcycle, sometimes 3 for the other kind. What about salary for the qualified quality control inspector? Well, that's a factory overhead. Yes, they're utilized, but it's not necessarily specifically just for this motorcycle. Safety helmets and masks for the assembly line workers. Those assembly line workers need to be protected. That is a cost in creating these motorcycles, but not specifically related to the motorcycles. But the assembly line worker wages would be a direct labor cost, because those assembly line workers, all they do is specifically to work on the completion of creating those motorcycles. Which of the following would be a period cost? Now know this, product costs are costs associated just with what's being produced. Period costs are costs that are incurred but are not linked specifically to the product. So when we look at the sales manager's salary, that is a cost that gets put in the period in which it was incurred. The factory supervisor's salary is part of factory overhead, which is part of the product cost. Heating costs of the factory would be factory overhead, also part of the product, and same with the rent on the factory. Here, as we look at these various costs, what we're going to see is identifying which of these items will be treated as factory overhead for Ford Motor Company. So you see we've got various air conditioner units for installation in vehicles, consultant fees for a study, dealership sales incentives, depreciation on the headquarters, depreciation on mechanical robots on the assembly line, leather to be used on the vehicles, machine lubricants, the plant manager's salary, property taxes on the headquarters, and then the vice president's salary, part of human resources. So again, the focus here is what are we specifically showing as factory overhead. Think about this, guys. Air conditioning units for installation in vehicles, that would be a product cost. That is specifically associated with one of the products we are creating. So that would not be factory overhead, because factory overhead is pretty generic over a broad topic for we need it in order to produce and manufacture these goods, but it can't be directly linked to what we're producing. Consultant fees for a study of the production line efficiency, yeah, that would make sense that that's part of manufacturing overhead, because you can't specifically relate that to one product. Dealership sales incentives, no, that's part of sales. Sales are not part of the product. That would be a period cost. Depreciation on the headquarter buildings, no. The depreciation on the factory building would be part of factory overhead, but the headquarter building is a period cost. This is related to administration, not related to specifically creating products. Depreciation on the mechanical robots, yes, that makes sense. Factory overhead. Leather. The reason leather would not be factory overhead is because it is a direct material associated with the specific product. So that would be direct materials. Leather to be used on vehicles that have leather interiors would be a direct material. You can specifically assign that to a product. That wouldn't be overhead. Lubricant, yes. Plant manager salary, yes. Property taxes on the headquarters building, no. But property taxes on the factory would be, but not on the headquarter buildings, because that would be a period cost. And then also the vice president of human resources, No, that's a period cost. That's related to HR. That's not related to whoever is supervising the factory. So please understand that factory costs are specifically linked with producing these goods. So I've got a lot of these exercises, but they're really going to help you in doing your homework. So that's why I have these. For apparel manufacturer, Abercrombie & Fitch, classify each of the following costs as either a product cost or a period cost. So the chief financial officer's salaries, period. Remember, product is only associated with the products we are manufacturing. Sales commissions are period. Property taxes on the factory, yes, those become part of factory overhead that ultimately get linked to the product. The depreciation on the sewing machines also is a product, as is the fabric. The utility cost on the office is a period. The utility cost that would be for the factory would be a product cost. Factory supervisors' salaries would be product. Depreciation on office equipment is a period cost because, again, guys, that has to relate to the running of the company, not necessarily the production of the products. If it was depreciation on factory equipment, that would be different. That would be a product cost. Oil used to lubricate machines, product. Advertising expenses, anything to do with advertising and sales is period. Research and development is period. But the repairs on the sewing machines, because those sewing machines are used to create the product, that would be a product cost. Salaries of production, quality control supervisors, that would be product. Salaries of distribution center personnel would be a period cost. Travel cost of media relations would be period. The factory janitorial supplies is product, along with the wages of the sewing machine operators. Guys, here the key is to be able to distinguish what happens in the period that gets put right onto the income statement would be period costs. The product costs follow the goods until they are sold. So this next exercise is having us look at this report of manufacturing costs, and we're going to try to get an understanding of where this is incorrect. So you see here, it tells us we've got materials that are used in production, and those materials used in production include 45,200 of indirect materials. So that's something we're going to look at. The direct labor shows 84,400 of maintenance salaries. That's another thing we're going to look at. And then in the factory overhead, the supervisor's salaries wouldn't be right for the plant. The heat, light, and power for the plant, that's right. Remember, factory overhead is going to encompass all those things that are not specific, directly related to the manufacturing of the goods. The sales salaries, that's not something that would belong to a product cost. As we saw in the previous slides, that would be a sales, a period cost. Promotional expenses also, that would not be related to the product. Insurance and property taxes on the plant, that would be right, but not for corporate offices, that would be a period cost. Depreciation on plant and equipment, that would be right, but not for the depreciation on corporate offices. The key here, guys, is to know what follows the product and what would be period costs. So, as we move on here, know that those maintenance salaries of 84,400 should be part of factory overhead. The indirect materials of 56,200 should also be part of factory overhead because those are not specifically related to the product. The maintenance salaries aren't those working on the assembly line. So that would be part of factory overhead. The factory overhead of sales salaries is wrong. That should be a period expense. Promotional expenses are period expenses. Corporate office insurance and property taxes, that would be a period expense. And corporate office depreciation would be a period expense. Remember, product costs only relate to manufacturing that product. Okay? So as you see here, the correct cost schedule is shown here. The materials used in production would just be direct materials for the producing those products, and direct labor would just be those directly on the assembly line. And then the factory overhead only includes those specific items for related to the factory. Anything corporate would be a period cost, and that flows right onto the income statement. So our third objective here relates to financial statements. Now, the statement of stockholders' equity and the statement of cash flows for a manufacturing business are just like those for service business or a retail business. But the balance sheet and the income statement are going to be a lot different and actually more complicated than what we would show for a service or retail business. Remember, when a manufacturer creates products and sells those products, the inventory portion of the current asset section of the balance sheet is going to be more involved. Also remember, products stay on the balance sheet until they are sold in the asset section. And unlike a retail business that purchases end products ready for sale, it's more complicated in a manufacturing business because there's a lot more aspects to inventory. Okay, so when we report these various product costs, the balance sheet is affected and ultimately the income statement when there's cost of goods sold is affected. So with the balance sheet, a manufacturing business shows three types of inventory. It will show raw materials that we sometimes call materials inventory, which is the cost of the direct and indirect materials that haven't been put into the manufacturing process yet. They're still sitting in the storage or the requisition room, and they are just sitting as raw product. Then there's the work in process inventory. What happens is the minute the manufacturing company begins to produce the product, it will stay in a section of inventory called work in process, which the direct materials, the direct labor, and the factory overhead go into this work in process section while they are being completed. But they're not yet completed. That's why they are work in process. Once those goods are finished or completed, then they will be transferred into a portion of inventory called finished goods inventory. They will stay in finished goods inventory until they've been sold. Once they get sold, then they are transferred out of inventory, which is an asset, and put onto the income statement. So here you see under the current asset section an inventory section of a retail store, a retail business. When you look at Legend Guitars, a manufacturer of guitars, you can see that the inventory section has many more aspects or sub-accounts to them. We've got a materials inventory, a work in process, and a finished goods section. Here, the income statement for a retail business and a manufacturing business, they differ in the reporting of the cost of goods. So you see with a merchandise, you see the inventory available for sale, ending inventory, and then your cost of goods sold. You see in the manufacturing section, it's a little more involved. You've got cost of goods manufactured, cost of goods finished that are available for sale. Then you've got your ending inventory and your cost of goods sold. So just a little additional steps here in our additional sections, I should say, as it relates to the manufacturing income statement. Know that a retail business determines its cost of goods sold by first adding its net purchases for the period to its beginning inventory. And then from that, it shows all inventory available for sale. Then once we have the ending inventory, that we know what the ending inventory is, we get to subtract that from all inventory available for sale to determine what the cost of goods sold is. With the manufacturing business, where those products are being made, we've got direct materials, direct labor, and factory overhead. So the manufacturing business has to determine the cost of goods that have been manufactured during the period, and that gets added to determining what cost of goods were manufactured during the period. So in this section here, the statement of cost of goods manufactured, this gets prepared using the following steps. We determine the cost of direct materials used during the period. Then we determine the total manufacturing cost incurred during the period. And then we determine the cost of goods manufactured during the period. Okay. I think I have that in here twice. I'm so sorry. So you see that the cost of goods that were manufactured on the statement of the cost of goods manufactured then flows to the income statement. So we pick that up from the cost of goods manufactured statement to then get the cost of goods manufactured from the cost of goods manufactured total down at the bottom of the statement cost of goods manufactured then is transferred onto the income statement. So here, guys, you see a exercise, financial statements of a manufacturing firm. Here it says that the following events took place for Sorenson Manufacturing Company during January, the first month of its operations as a producer of digital video monitors. So we've got several different items that transpired, processes, transactions that took place. We purchased $250,000 of materials. B, we used $180,000 of direct materials in production. C, we incurred $450,000 of direct labor wages. D, we incurred $180,000 of factory overhead. E, we transferred $760,000 of work in process to finished goods. F, we sold goods for $1,200,000. G, we sold goods with a cost of $675,000. And then H, we incurred $125,000 of administrative expenses. So what we need to do is prepare a January income statement and then figure out the inventory balances at the end of the first month. So we know that for our revenues, we show the $1,200,000 in revenues. The cost of goods sold shows a cost of $675,000. We've got our gross profit then of $525,000. Our selling expenses are going to be $215,000, and our administrative expenses are $125,000. So our net income ultimately will be $185,000. Okay? As you see here, the cost of goods sold is the only piece that will go into the income statement. For inventory balances, we know we had $250,000 of materials we purchased, and we used up $180,000 of the direct materials in production. So our ending balance of materials would be $70,000. Our work in process, we're going to have the $180,000 incurred in factory overhead. We're going to add the $450,000 of direct labor wages, also another $180,000 of direct materials in production, and we're going to subtract out the $760,000 that was transferred to finished goods. So our work in process at the end of the month is sitting at $50,000. Our finished goods, we transferred $760,000 into finished goods, but we sold $675,000 of finished goods. So our finished goods inventory is going to be sitting at $85,000. Okay? This next exercise, exercise 111, discusses the cost of direct materials used in production for a manufacturing company. So here you see Gabetis Manufacturing Company reported the following materials data for the month ending September 30th. We have materials purchased of $815,900. We have materials inventory. We started the month with $235,200. And then our materials inventory at the end of the month was sitting at $203,000. Our job is to determine the cost of direct materials that were used in production during the period. So what we'll do is we will show we started with $235,200. We added or purchased $815,900 during the period. So we had available for use $1,051,100. Then at the end of the period, if we were sitting at $203,000, that means we moved cost of materials used in production that were transferred from direct materials into work in process is $848,100. Now for this exercise, I show that there are two items here that are omitted from these lists of cost of goods sold from a manufacturing company's income statement. Determine the amount of the missing items by their letter. So we know here the A is going to be adding the finished goods to the cost of goods manufactured to show the cost of finished goods available for sale. Okay, we're going to just add those two to get our cost of finished goods available for sale. Finished goods plus those that have been manufactured. For B, we're going to show the difference between the cost of goods available for sale minus the finished goods inventory. The difference is what we sold, what's no longer there. which will be the $812,000. As you see on the second column, we should be able to take the finished goods inventory plus the cost of goods manufactured will equal our cost of finished goods available for sale. So in this case, if we take the $540,000 and subtract our finished goods inventory, that's going to be what we've manufactured. Then what we've cost of goods available for sale minus our finished goods inventory would be then what was sold. Okay, which is our $470,000. Again, this third column, the finished goods inventory plus cost of goods manufactured gives us our total cost of finished goods available for sale. So you would add the two to get cost of goods finished available for sale. In this case, to find E, we would take the $1,100,000 and subtract the $180,000. Then, to find out what our finished goods inventory is, cost of finished goods available for sale either will be in finished goods inventory or will be sold. Okay, so you take the $1,100,000, subtract the cost of goods of $945,000, and there you will find what your finished goods inventory is. The finished goods inventory there would be $155,000. I hope that's making sense to you. Here, this exercise allows us to work on a cost, the statement, the cost of goods manufactured for March. So as you see here in this slide, cost data for Firetree Manufacturing Company for the month ending March 31st is shown here. So we've got the beginning inventories of materials, the beginning inventory of work in process, and of finished goods. And then we've got all the various expenses for the period. So we're going to do two things here. We're going to prepare a cost of goods manufactured statement for March. And then we're going to determine what was sold during March. So this statement is very specific how we need to create it. And feel free to use one of the exhibits in the book, the textbook, so you know the process. You start with the beginning work in process inventory for March 1st. $428,700. Then we'll just deal with our direct materials. We start with the materials inventory at the beginning of the month. We add our purchases to show our cost of materials available for use. Then we subtract out the materials inventory at the end of the month to find out what was the amount of the cost of direct materials put into production. Then we add our direct labor. Remember, the direct labor are those salaries specifically on the manufacturing line, the assembly line. The factory overhead has a lot. It's going to have your indirect labor, the machinery depreciation, utilities, supplies that aren't directly related to the products, property taxes, and other costs. That gives us our total factory overhead cost. So we then take the manufacturing costs that were incurred in March, which would be the cost of direct materials put into production, the direct labor, and the total factory overhead, to give us the total manufacturing cost in March. We add that to our work in process that started the month to give us our total manufacturing costs. We subtract out the work in process at the end of the month, what is still being produced, And from there, we come up with the cost of goods that have been manufactured. Okay, so those cost of goods that are manufactured will eventually go into the finished product inventory. Now, what was sold during the period? We start with our finished goods inventory. We add to that our cost of goods manufactured, which would have been then the cost of finished goods available for sale. We subtract the ending inventory at the end of the month, and those had to have been sold. It always adds up. Now here's another problem that's helpful, I believe. If you're looking at this, this is a lot of your homework. So if you look through here, that will help you. Here's information for Robstown Corporation. All kinds of expenses here. And our job, is to prepare a cost of goods manufactured schedule. So we're going to kind of do the same thing. We start, just like in the previous problem, with the work in process at the beginning of the month. Then we sort out the materials inventory. We add the purchases, and then the cost of materials available for use. If we subtract out the ending inventory of materials, we find the cost of materials put into production. We add our direct labor, and then we go through all of our factory overhead. I see here my indirect labor. I hit a T instead of putting in the amount. So that indirect labor was $115,000. Okay, this number should be $115,000. We add the depreciation, the heat, the property taxes, rent, supplies, miscellaneous costs to total our factory overhead. We add the three of these together to come up with our total manufacturing costs that was incurred during 2028. If we start our beginning inventory plus our manufacturing cost incurred, we get our total manufacturing cost minus that work in process still in inventory at the end of the year will give us the cost of goods that have been manufactured. Now, to prepare an income statement, we'll show the sales. We will show the finished goods as of January 1st of the year, what we manufactured during the year, what's available. We subtract out the ending inventory of finished goods to come up with what our cost of goods sold is. Sales minus cost of goods sold will be our gross margin, sometimes called gross profit. We then take the direct, period expenses, anything related to corporate, office salaries, depreciating the equipment, property taxes on the office building. Remember, on the income statement will be corporate headquarters expenses. Anything to do with the product goes into the the product cost. Period cost relate to corporate. We have admin, and then we have selling expenses. Advertising will be a period expense, which means it gets expensed in the period that it was incurred. So we add our advertising and our sales salaries to come up with our total operating expenses. And after that, our gross margin less our total operating expenses gives us our net income. So, next, we are going to look at how manufacturing costs flow. Know that material purchases go right to the balance sheet. It's an asset. It's an inventory, a current inventory, or I should say a current asset. Labor can be direct labor or indirect labor. If it's direct labor, it goes right into work in process on the products. If it's indirect labor, that goes straight into manufacturing overhead. Remember, labor is going to be either in the factory, it will be either direct labor or indirect. If it's direct, it goes right into work in process. If it's indirect, it goes into manufacturing overhead. All other overhead costs go directly into manufacturing overhead. So then your manufacturing overhead will then be lumped as a whole into the work in process. Know that the work in process is going to be a combination of direct materials, direct labor, and manufacturing overhead. The work in process will have a beginning balance and an ending balance. That which got transferred out of work in process will then go into finished goods. Finished goods will also have a beginning balance and an ending balance. And the total finished goods available less the ending finished goods balance is going to be what was sold, the cost of goods sold. Okay, which of the following is calculated for both a manufacturer and a retail business? Would it be cost of goods manufactured, ending work in process inventory, cost of goods sold, or ending raw materials inventory? What do you guys think here? Cost of goods sold is what both a manufacturer and a retail business have in common. Remember, with a retail business, they just purchase the finished goods, so they don't have anything to do with cost of goods that are being manufactured or work in process and ending raw material inventory. All of that is unique to a manufacturing company. So here we have decision making, utilization rates. Here we look at how we determine utilization. So in a hotel industry, utilization gets measured by occupancy rate. Occupancy rate would equal the guest nights divided by available room nights. So if guest nights are those number of guests times the number of nights per visit, and the available room nights are the number of rooms available times the number of nights in a time period. So if you have 100 rooms and you have 31 nights in a month, that will be your available room nights. A utilization rate measures the use of a fixed asset in serving customers relative to what the asset's capacity is. Again, we want higher utilization rates. That means the hotel's getting filled up. Higher utilization rates are favorable. Lower utilization rates mean there's a lot of empty rooms. So depending on what type of service we're dealing with, different service industries are going to have different types of names for this utilization rate and different ways they compute it that measure, are they favorable or are they not favorable for that particular type of industry. Here we see with when we're dealing with manufacturing versus service companies, both will use managerial accounting. Managerial accounting is for guidance and input for those individuals within a company to help them make decisions. For manufacturing, we've got materials, work in process, and finished goods. For services, it's pretty much just limited to supplies. Now, there's all different kinds of services available. If you think of a hospital, that's a service. They're going to have a variety of different supplies to take care of those patients. For a tax business, we're really just dealing with paper and ink. With a manufacturing company, we use product cost and period cost, but for a service industry, all we're going to use are period costs because we don't have any manufacturing. With manufacturing, we use cost of goods sold on the income statement, but for services, there's not a cost of goods sold. We have costs for services, but we don't have a cost of goods sold because we're not selling products. Manufacturing companies require a physical production site, where a service company requires a network of connections to the service and the customer. We might have telecommunications, banking, power distributions, or entertainment, transportation, different ways we connect and provide that service to people. For manufacturing, we've got manufacturing overhead is an indirect cost in the manufacturing products. Where with a service industry, we have overhead. That's an indirect cost to serving the customers. In manufacturing, we've got labor, can be a direct labor or indirect labor, but ultimately all labor goes into those products within the manufacturing of the products. With services, labor is not a direct cost to products, it's a direct cost to customers. Accountants in an accounting firm, doctors in hospital or a medical practice, nurses, those are all expenses directly to the customer. With manufacturing, materials are a direct cost to products. For a service industry, materials are an indirect cost, but they're still significant. You still need them. As you see here, fuel for transportation or utilities. In other cases, materials are not significant. Okay, so it just really depends on the type of practice or business you've got. Here's examples of service industry. We've got in the utilities industry, there could be electric power. And you see some names here, Consolidated Edison. For transportation, we've got overnight delivery FedEx. Information or fun, social media is Facebook. Financial services, banking's an example, Bank of America. Education, for higher ed, we could have Anoka Ramsey, or in this case, the University of Phoenix. I think it's all online. Hospitality, entertainment, Disney Company, or health's a service industry. We could have hospital corporations, personal services such as fitness clubs, Lifetime. So I hope this has been a good overall understanding of what we're going to talk about in managerial accounting.